Welcome to My Money Mindset podcast, where we explore how a healthy mindset is the foundation for financial success. Each week, we delve into mindset hacks and practical strategies to help you enhance your income, help you make more appropriate investments for yourself, and to improve your overall financial well-being. Join us on this journey to transform your financial future by transforming your mindset. Please note that the information provided on this podcast is for general information purposes only and does not constitute as personal, financial or health advice. It has been prepared without considering your individual objectives, financial situation or life needs. Before making any financial or health decisions, you should consult with a qualified professional or financial advisor to ensure the information aligns with your specific circumstances. So let's begin and enjoy this journey as each episode teaches us on how to improve our overall mindset that overall improves our financial success. Welcome to another episode of Money Mindset. This one's an important episode simply because it revolves around the ATO and what they're doing with the interest charges on the ATO debt. So as of July 1st, 2025, the general interest charge, what they call the GIC, will no longer be tax deductible, which means all self-employed people, business owners, etc., incur these charges on or after that date of July the 1st, 25, and they will effectively pay the full unreduced cost of that interest, which is currently around 11.17 at the moment, right? So what does it mean? It basically means that previously, self-employed individuals could claim a tax deduction for the general interest cost, which reduced the effective cost, right? So for someone that's on a top marginal rate of, let's say, 47%, this meant almost half of that general interest cost could be offset. But as of July 1st, 2025, that deduction is gone, leading it to a much higher after-tax cost of having ATO debt, right? So the ATO debt now at 11.17% is no longer tax deductible, right? Greater incentive for timely payment, which basically that's what it all means, is that the change is designed to discourage taxpayers from using ATO debt as a form of cheap financing. So everyone's going, well, why are they doing that? It's simply because it's going to discourage taxpayers from using the ATO as a cheap form of debt financing. So the increased cost makes it financially imperative to pay the tax liabilities on time, right? It sort of pushes people to do that. Or they have to seek sort of an alternative or potentially cheaper financing, which normally can be done through banks. And there's a lot of banks that actually can fund your ATO debt. So don't think that it's all doom and gloom at the moment. There are other solutions that are actually now going to be probably cheaper for you if you strategize and do it right. So this is going to have a massive impact on cash flow too, as in the management of your cash flow. So what I mean by that is that businesses that are sort of relied on payment plans with the ATO sort of thing, perhaps seeing the deductibility interest as a manageable cost, like as in they're already being able to claim it, they sort of now will sort of face the financial reality that they cannot claim this cost in their business as in a cash management sort of strategy. And what the ATO is sort of specifying it, there's no real grandfathering with this. So it's crucial to understand that the change for this general interest charge incurs on or after the 1st of July 2025, regardless of when the original liability arose. So what that means is that if you had an existing ATO debt with a payment plan exceeding beyond this date, any of the general interest charge incurred from July the 1st onwards will not be deductible. Yeah. So July the 1st, 2025 is the trigger point where it just simply, there's no grandfathering on your debt, which is also, very heavy news for those that sort of rely on it type of thing. Well, not that they rely on it, but they use it in their managing of cash flow, right? So what should they do? Well, basically, that's the silver bullet question, but obviously speak to your accountant or financial advisors, brokers, that sort of thing, and get something going. Prioritise in clearing the ATO debt before July 1st. If possible, pay it off any outstanding ATO debt, especially if those are incurring, GIC and before the end of June 2025 to benefit from the last opportunity to deduct the interest. So make sure that you get that in before the end of financial year. Review your existing ATO payment plans. And what I mean there is if a client has an active payment plan with the ATO, they should probably review that immediately to understand how much general interest charge will be incurred after the 1st of July 2025. Remember, it's not deductible after that date, and explore other options to pay it off sooner, which means maybe have a look at speaking to your broker about what payment loans that are available, what banks are offering it. There's a massive amount of banks out there that are focused on this sort of thing. That's their bread and butter, and they're happy to help. So don't always think that there is solutions out there. What you've also got to do is explore alternative financing options. So compare that 11.17% that I was talking about before, which in brackets is compounding daily, and it's non-deductible. Remember that? So with commercial loan rates. So it's highly likely that a business loan or line of credit or even a tax debt loan from a commercial lender will be significantly cheaper than the 11.17, right? So considering the interest on commercial loans is generally still deductible, where incurred from business purposes. So, and this is why I'm saying you've got to speak to your accountant when it comes to this type of thing, because if it means that the debt you're going to incur with a bank for the interest, for the tax debt, that means that interest is tax deductible, right? It's not like it's connected to that or in any fashion. So if you're paying that loan, if you're getting that loan from the bank to pay that tax debt, that is still deductible, the interest that you're paying back to the bank because of the tax debt. Okay, so, and it also strengthens your cash flow management. So the change sort of makes proactive cash flow management more critical than ever, right? So what we've got to make sure is that if we are looking at forecasting develop realistic cash flow forecasts, if we're looking at doing that, I would encourage do that sooner than later. Sort of anticipate tax payments, due dates, ensure sufficient funds are available. Don't always leave it to the last minute, and always set aside funds, right? Make sure that, and I did an episode on cash flow, but I'll just briefly go over it as well, as in make sure that you're invoicing promptly and you're chasing your debtors. Improve the collection process, right, guys, in your business, making sure that that money comes back. Don't forget, everyone is incurring this new policy with the ATO, so everyone's in the same boat. But if we can all sort of manage our cash flow better and improve it, we will certainly help. Manage expenses tightly, so control discretionary spending, and potentially negotiate with your suppliers. Everyone's there to sort of in business to make money, but they also need to be able to be negotiated with terms and stuff like that. Look, I'm not saying it's going to be the be all end all, but you've got to make sure that your cash flow is fairly buoyant, and there are ways of getting this done strategically, especially if you're thinking business might be different or whatever. Then speak to a broker or your accountant, or even give me a call. It doesn't really matter, and work on a proactive management with the ATO or your business, that sort of stuff. You really want to make sure that you don't sort of leave this too long. A must is that you've got to work in closely with a tax agent or an accountant. It's a complex area, tax and finances and cash flows and managing your business, let alone your financials. And a professional can always sort of provide you that tailored advice specific to your needs, not just in a general sense. Like it really is important, guys, that help with your cash flow planning. It's one of the most important things. Cash flow, like I say, is the blood flow of your business, and make sure that you explore the best strategies specific for managing your tax obligations, especially in light of all the changes that we're facing now with the ATO and the general interest charges, right? So in essence, it's pretty much clear. Being late with ATO payments will become significantly more expensive as of the 1st of July 2025. Proactive management and seeking alternative finances are now more important than ever for self-employed individuals and businesses. So make sure you get onto it, guys. Don't leave it too late, and speak to someone. Speak to the professionals. Yes, they're busy this time of year, but make sure you get some answers, and quality answers that are specific to you, and really get in there fast, because we leave these things too late and it always affects the cash flow down the track, as we know. All the best, guys. I hope this episode helps.